Now let's do some questions on portfolio theory and CAPM. So my objective is to do as many questions as possible. So starting with December 2025. Question 2B. Question 2B. So question 2B, now let's start with the 2A. 2A. Explain the following terms as used in international financial management. One is the PPP, the purchasing power parity. And you see that for the purchasing power parity, so those are the methods or theories which are used to determine or to predict the exchange rate of a currency. And we see that there are three theories. One of the PPP, and we see that for the PPP, the inflation rate is the major determinant. And then for the interest rate parity, that is IRP, we say that the key determinant is the interest rate of the rand, and that means of the country. Then we have the international Fisher effect. So that for IFE, it assumes that the inflation and the interest rate of different countries should always offset at equilibrium. And then there is arbitrage what? Opportunity. See that what is arbitrage? To arbitrage. Remember I said that in international financial market, under financial derivatives, there are 4 participants. And one there was what? They are hedgers. Hedging is a strategy to minimize risk, right? So that hedgers, they are those participants who enter. Okay, I'm not answering that. I'm helping you to do revision. So hedgers, they are those participants who enter into the market in order to do what? To minimize on risk. And you say that their major concern are the savings. Then the next one, we say that they are who? Arbitragers. Now, before arbitragers, there was speculators. To speculate. What do you mean to speculate? They are those participants who enter into the derivative market in order to make profit. Therefore, we say that for them, they don't fear risk because they are there to make the profit. Then there was arbitragers. So that those are the participants who enter into derivative markets to make short-term gains from the fluctuations of the prices. And we have just answered that, the arbitrage operations. So the arbitrage, the key concern is to make short-term gains. Do you remember when you're doing also the international triangular arbitrage? Yes, wherever you are trying to determine the gain, it's all about the short-term movement. And that's how you get your 4 marks. And then we go to part B. Yeah, this paper you are supposed to do it with only 1.5 hours. 1.5 hours. Because I think most of the questions we have already done them. We have already done them. So part B, Haraka Company Limited has the following 4 short-term portfolio of investment made from the accumulated retained earnings over the years. So we have company W, X, Y, and Z. We have the number of shares. We have the equity beta coefficient, market price per share. We have the dividend yield for 2024. And then we have the expected returns on the equity. Added information. The current market return is 19% per annum. That is the expected return of the market. Number 2, the risk-free rate is 12% required. Calculate the risk-free of the company's short-term investment portfolio relative to that of the market. So calculate the risk of the company's short-term investment. These are securities. So how do you measure the risk of the security? The risk of security is measured using the beta factor. So therefore, what we need here is the weighted beta of the portfolio. If you combine the securities, more than one investment is what we call a portfolio. And how do we get the weighted beta? It's very simple. So to get the weighted beta of the portfolio is very simple. How do we get that? How many securities do we have? There are 4 for company W, X, Y, and Z. So we'll be taking weight of W, beta of W, weight of X, beta of X, weight of y, beta of y, and weight of z, beta of z. Do we have the betas? We are given the beta. So what we need to determine are the weights. And how do we determine the weights? It's very simple. So we have the company X. We have W, X, Y, Z. Then we have the number of shares. So we are given the number of shares. Here we have it's 120,000. Here we have is 160. Here we have 200. And here we have 250. Then we have the market price per share. Can you see the market price per share? Yes. So the current market price per share, this one is 42.9. This is 29.2. This is 21.7, 31.4. And that's how we get the current equity value. Good. So take 120, each at 42.9. Let's make our work to be easier. Give me in thousands. Just take 120 times 42.9. 51? 48. 160 each at 29.2. Sorry? 46.72. 200 times 40? 43? 40. 250 each at that 1.4? 78? 50. Now give me the total equity value. Give me the total equity value. $22.0. We convert it into weights. 51.48 divided by 22.010. 0.23. 46.72 over the total. 0.21. 0.2. Now roughly should be 64. That is 36. 36. Good. So now we can be able to get the weighted beta. Yeah, the risk of the portfolio or the risk of the security, if you combine them to form a portfolio, we already have the beta, so we measure using the beta. Weight of B or weight of W, which is 0.23 beta of, this was beta of W, sorry. How much was the beta of company W? Yeah, it's 1.2. Weight of X is 0.21 times the beta of X, which is 2.3. Weight of Y, which is 0.2. And then beta of Y is 0.85. And then lastly, weight of Z is 0.36. Beta of Z is 1.28. That's how we get the weighted beta of that portfolio. Get 1.39, 1.39. That is number one. Number two of the question. Recommend with reasons whether Haraka Limited should change the composition of the portfolio. Now, this portfolio is made up of shares of 4 companies. So whenever you're told that to advise, in this case, it's all about determining on whether these securities are super efficient or inefficient. And how do you determine that? You compare 2 things. The expected returns against the returns of those securities. So we have the companies W, X, Y, Z. You compare the expected returns against the returns of the security. And we have the expected returns or the average return. Expected means the average. Do you have the average returns? Yes. So for W, it's 9.5. This is 15.5. This is 12.5. This is 7.3. To get the return of the security, you take the risk-free expected return of the market minus risk-free. You multiply by the beta, added information. Number 2, the risk-free rate is 12. So risk-free rate will be 12. Then you add note number 1. The current market returns is 19%. So the expected return of the market, it's 19, minus the risk-free rate, which is 12. Then you multiply by what? By beta, and of which we are given the beta. Beta for company W, it's 1.2. This is 2.3. This is 0.85. This is 1.28. Good. The first one is 20.4%. Sorry? 28.1%. 17.95. 20.96%. Then we comment. So you see that when the expected returns is greater than the return of the security, that's when the portfolio of the security is said to be super efficient or has been undervalued. 9.520, super or inefficient? This is inefficient. All of them, they're inefficient, right? Inefficient, inefficient, inefficient. When it's inefficient, that means has been overvalued. Good. Now, what was the question? Recommend with reasons whether Haraka Limited should change the composition of the portfolio. Yes, they should change. They should change by selling. This is inefficient, 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 inefficient. When they are overvalued, sell them now as soon as possible. If you sell them now, you are going to get abnormal profits. So, yeah, when we say that they're inefficient, it means that they are so they are trading at a higher value, at a higher market price compared with their real value. So if possible, sell them now before they realize the true value. So to change the composition, they should change by selling all the securities since they are overvalued. They are overvalued. In case they were super efficient means that they are undervalued. If they are undervalued, buy as many as possible. When they are undervalued, buy them at the lowest price. You buy them so that when they realize the true value, the value will increase and you make the abnormal profit. But in this case, they are overvalued. Sell them now. Part C of the question. So we are done with part B. Zigma Limited is a mutual fund investment company and has invested in the following 3 schemes. So there is scheme X, Y, and Z, a dividend distributed, there is capital appreciation, opening net asset value, and then we have the beta, added information. The treasury bill rates, which is considered risk-free, is 7.84. That's the risk-free rate. Number 2, the market portfolio is 13. Required, compute the Jensen's alpha for each scheme. So those are the measures used to evaluate the performance of the portfolio. You see that Jensen's alpha, it uses alpha. And how do we get the alpha? Alpha is the difference between the expected returns and the return of the security. That's how we get Jensen's alpha. So how do we get the expected return? At least you know how to get RS. Now, these are 2 different companies also. So how do we get the expected return? If you are not given the expected return, let me take you back. To get the percentage of returns, we say that you take P1 minus PO times 100. That means if you buy a share at 100 shillings, and then at the end of the year, the share price increases to 110. You bought it at 100. At the end is 110. So how much is the increase in price? The capital gain is how much? 10. That's what we call the capital gain. Now, give me that in percentage. It was an increase by how much? We're working with this scenario. I'm trying to support this formula. An increase by 10%. So what have you done? Okay, this is PO, the beginning price. This is the ending price. So you have taken 110 minus 100. You get how much? What do you call that 10? The capital gain. Sawa. The capital gain. Then you divided by the initial price. The initial price was how much? 100 times 100. And that's how I got 10 per. So that's how you get the returns. And this one, you can be able to get it. Now, if you look at this question, can you go back to that question? In that case, P1 minus PO is the capital gain. But in this case, they are still earning some dividends. So therefore, what you'll do in this case, to get the total return, you'll be taking P1 minus PO to get the capital gain or the capital loss. Then in addition, these shares, they're earning what? They are earning dividends so that you get the relative return times 100. So what I have done to get the expected return, I've taken the capital gain plus the dividend so that you get the relative return. You divide by the initial investment. That is PO. Then you multiply by 100 and we have it. So we have for scheme X, Y, and Z. Can you see the capital appreciation? That's what we call the capital gain. How do you get the capital gain? It's P1 minus PO. So there was the capital gain, which was an amount of 29.7. This was 35.3. This was 19.9. Then in addition, they earned some dividends. X, how much is the dividend? 17.5. Y was 0. This one was 13. And that's how you get the total return. You divide by the initial, and you are given the opening net asset value. So at the beginning, the value of the investment, this was an amount of 320, 271.5, 235. And then should be always in percentage. Yeah, the returns are always expressed in percentage. This one is 14.75%. Yeah, so that was the return for scheme X. This one is 13%. 14%. So what are we calculating? Jensen's alpha, right? Which is the difference between the expected return, of which now we are sorted. We have the expected returns. You compare against what? Return of the security. Scheme X, Y, Z. So to get the return of the security, you take the risk-free expected return of the market minus risk-free. You multiply by the beta. Are you given the risk-free? Yes, number one. Show information number one. The treasury bill rates, which is considered risk-free, is 7.84 plus, note number two, the market portfolio is 13%. So that is the expected return of the market minus the risk-free rate of 7.84. Then you multiply by the beta. Do you have the beta? Is a measure of risk. This is 1.3, 0.9, and 1.4. The person is 548, 12.48. Sorry? 0.06%. So now we can be able to get our Jensen's alpha, X, Y, Z. So to get alpha, you take the expected return minus the return of the security. So the expected returns, this was 14.75, this was 13, this was 14. We minus RS, this is 14.548, this is 12.48, 15.06. If you get a positive, it indicates a superior performance or super efficient. 0. 202. You get 0.52. This one must be negative. Negative 0.94, right? 1.0, which is negatives. Even we can comment. Remember, this is in relation to the portfolio performance. Now, if the expected return is greater than the return of the security, what I was explaining here, if the expected return is greater than the return of the security, that's when you say they're super efficient. And that's when you get a positive value. If it's negative, this is when the return of the security is greater than the expected return is said to be inefficient. But in relation to the portfolio evaluation, you see that it's a superior performance. Superior. Okay, let's write super efficient. Super efficient. Since they are positive. Also, this one is super efficient. What about this? Inefficient or inferior performance. Good. Then number 12, the question. Recommend to Zima Limited the scheme to continue to invest in based on the scheme performance. Which one to continue? So continue with scheme. Yeah. X and Y. And then you do what? And discontinue. You discontinue Z. Good. That's how you get your 20 marks. That question had 20 marks. So you can take a screenshot. August 2025, position 2C. August 2025, position 2C. Prime Actual Investors Limited have the following portfolio of 4 risky assets and have deposited in a risk-free asset. The table below shows, or the table shows portfolio weights and the current assets return together with their beta coefficients. So you have asset A, B, C, D, and we also have a risk-free asset. Then we have the weights, those are the proportions. Then we have the current return. Now that's what we call the average return. Can you write it as ER? Write it as ER. Yeah, the current return is what we call the expected or the average returns. And then we have the beta. If you look at the beta of the risk-free asset, is how much? 0. Yeah, a risk-free asset is an asset with no systematic risk, and therefore the beta will be 0. The overall return on the market portfolio of risky asset is 12%. Now that is ERM, the expected return of the market. And this is expected to continue for the foreseeable future. Required, compute the current returns of what? Whenever they talk about portfolio is when you combine all of them. So you compute the current return. That's what we call the expected return of the portfolio. So to get the expected returns of the portfolio is the same as the weighted. You take weight of A, returns of A. Are you together? Let's do that. Can you see the weights? Weight of A is 0.3. So you take weight of A, current returns of A, which is 18. For B, the weight is 0.15 with a return of how much? 20. For C, the weight is 0.2 with a return of how much? 16. Then for D, the weight is 0.35 with a return of 10. Also, we have a risk-free asset with a weight of 30% with a return of 8. So when you combine, you form a portfolio. So how much will be the average? Seventeen point 17.5%. That's number one. Number two of the question. Ascertain the beta value of the portfolio. Portfolio is the combination, the beta of the portfolio. So to get the beta of the portfolio, we are saying that is the weighted beta. We do the same what we have done here. You take weight of A, beta of A. So weight of A is 0.3. How much is the beta for A? 1.8. Then you take beta of B, sorry, the weight of B, which is 0.15, beta of B, which is 2.2. Weight of C is 0.2 with a beta of 1.5. Weight of D, it's 0.35 with a beta of 1.2. And then for the risk-free, the weight is 0.3 with a beta of 0. So when you combine them, you form a portfolio. So how much will be the beta of the portfolio? 1.59. Number 3. Identify out the 4 risky assets. Out of the 4 risky assets, the ones that are inefficient, efficient, and super efficient. How do you make that decision? By comparing 2 things. The expected return against the return of the security. Good. So here we have the assets. We have A, B, C, D, and the risk-free. You compare the expected return. Expected means the average, and that's what you're given as the current returns. So for A, we have is 18, 20, 16, 10, and this one you have is 8. You compare against the return of the security. Risk-free rate, expected return of the market minus risk-free multiplied by the beta. The risk-free rate we are given. Can you go have the risk-free rate? Can you see the risk-free rate? It has a return of how much? How much is the return of the risk-free rate? 8. Good. So you already have the risk-free rate is 8. Then we add the last paragraph here to that. The overall return on the market portfolio of risky asset is 12. So the expected return of the market is 12 minus the risk-free rate, which is 8. Then you multiply by the beta. How much is the beta of A? Yeah, this is 1.8, 2.2, 1.5, 1.2, 0. Fifteen point? 15.2. 16.8. 40. 14. 12.8. And then we comment. A security is said to be super efficient. You don't have to cram the inefficient, only super efficient. When the expected return is greater than the return of the security, that's when you say that is super efficient. 1815, yeah, this one is super efficient. 2016, also this one is super efficient. 1614, it's also super efficient. 1012, this one is inefficient. 88, efficient. Good. Number 4. Based on the findings in C, agree above, state the prediction that you'd make regarding to the future assets value and the rate of return. Let me answer it here. The prediction. These are super efficient, inefficient. So what will you do? It's all about buying and selling. Are you together? You are trying to change the composition in the future. So this is super efficient. Okay, super efficient means they are what? They are undervalued. If they are undervalued, do what? Buy as many as possible. This one you should. This one you should. This one you should. Now, this is inefficient. Inefficient does not mean it's bad. Are you together? Inefficient, that means that in the market they are over. So what do you do now? Sell them now, because in the market they're offering higher value than the current value. Efficient, you retain them. So. Then lastly, number 5, compute the equilibrium return of this portfolio, assuming the weights remain unchanged. So now that is the weighted RS. You see, you already have the expected return, the average. Now this is RS, assuming the weight does not change. Give me the weight of A. It was 0.3. Are you together? It's 0.3, now has a return of security RS of 15.2. Weight of B, was it 15%? It will be 0.15. Its return is 16.8. The other one was 20%, so it will be 0.2 with a return of 14. The other one was 35, 0.35 with a return of 12.8. And lastly, 0.3 with a return of 8. So give me that. 16.76. Good. So you can take a screenshot. August 2024. August 2024. Question 2B. August 2024. Question 2B. Now let's start with the question 2A. Examine 3 methods that could be used by multinational corporation to finance international trade. Only 3. Should be having at least 10. How can you finance your business? If you're taking your business to another country, that's what we call multinational. And how can you raise funds? How can you finance them? Number 1, there is equity finance. You can issue shares and equity finance. Another one is debt finance. But for the debt finance, actually, if you write debt finance, that one has like 4 points, right? Issue of debenture, write as issue of debenture. There is loan borrowing. That's a different one, loan borrowing. And there is freezer. We call them bank overdraft. Are you together? For a company, we call them bank overdraft. Another one is asset financing. Asset financing. Yeah, for example, instead of buying machines, you can just talk with a leasing company. Asset financing. Also, leasing. Leasing is a different from asset financing. Also, cash. Etc. etc. Part B of the question. Part B of the question. Kiwanda Limited, an all-equity financed company, is contemplating setting up a manufacturing plant overseas. So that means in another country. The expected payoff from the project would depend on the future state of the economy that might prevail as shown below. So you're given the state of the economy, the probability, then we have the forecasted rate of return. So we can say that our new project, we want to undertake in a new country, let it be X, and we can be able to get expected return. Expected means what? Expected means average. So if you're told that the forecasted rate of return, it can be 10, and the probability of that happening is 0.2. It can be 15 with a probability of 0.3. It can be 7 with a probability of 0.4. It can be 12 with a probability of 0.1. So how much will be the average returns? The average is what we call the expected. So if you are to take this project, the expected returns will be how much? Sorry? 10.5%. And since we are not sure and you're given the probability, we can even measure the risk of this, of which the risk is measured using the standard deviation. So how do we get the standard deviation? So we call it standard deviation of X because the new project, we assume it's X. So that you take the expected return, you take the summation of returns, you compare against the average return square, probability you get there. Now we are given the return can be 10, 15, 7 or 12. You compare against the average. So the average we have is 10.5. What you get you square times the probability of occurrence. Probability of getting a return of 10 is 0.2. A return of 15, probability is 0.3. A return of 7 is 0.4. A return of 12 is 0.1. The first one is 0.05. Six point 0. 7.5. Hey, let's hurry up. 4.9. Last three. 0.225. Good. Now give me the total. 20? 25. 6 plus 4 is 10. 11.5. So therefore, the standard deviation, you get the square root. You get 3.35. Good. So you have the expected returns or the average returns, and the standard deviation is 3.35. Added information. The company's portfolio of existing activities. The new project is X, that's our existing activities, B, Y. New X, existing is Y. So I told that the company portfolio of existing activities are expected to generate an overall return of 18. So expected returns of Y, it will be expected return of X will be how much? 10.5. With a standard deviation of 5. The standard deviation of Y will be 5, but standard deviation of X is 3. Good. If you combine the two, you form a portfolio. Number 2, the correlation coefficient of returns of the new project and the existing portfolio. That is what we call the correlation between X and Y. The correlation coefficient of return of the new project and the existing portfolio activities is 0.6. And the correlation with the market is how much? So the correlation between X and N is the one you are given is 0.24. Number 3, the forecasted rate of return of the market portfolio and their probability of occurrence in different state of nature is as follows. Now, what is that? We read that again. The forecasted rate of return of what? Can you add the word market portfolio? Market portfolio. And their probability of occurrence in different state of nature are as follows. So we're given the state of the economy, probability, and the forecasted return. So that means we can be able to get the expected returns of the market. So you get the average. So for the market can either be 20 with a probability of 0.2, can also be 15 with a probability of 0.3, can also be 10 with a probability of 0.4, as well as can be 5 with a probability of 0.1. So how much is the expected return of the market? 13. Since you are given the probability, that means you are not sure. So therefore, you determine what? The standard deviation. Standard deviation of the market, you take returns of the market minus the expected returns of the market, square, probability, then you get the, first of all, take the summation, then the square root. Returns of the market, we have 20, can be 15, can be 10, can be 5. You compare against the expected return. The average is 13. Then you square times the probability. Probability was 0.2, 0.3, 0.4, 0.1, 7, 49. That is 5 point. This is 10.8. 9.8. 4, 1.2, right? 3, 9. 9 times 4, 18. 36. 30. 3 point? 6.4. This one is 3.6. Now give me the total. Then you get the square root at 4 point. And then number 4, the risk-free rate of return is 8% required. Compute the covariance of the returns of the new project and the existing portfolio. Covariance. So how do we get the covariance? So to get the covariance between X and Y, I gave you how many formulas? 3, eh? Is a summation of returns of X, expected returns of Y minus expected returns of, you multiply by what? X is our new project of which you are given their respective returns. Are you together? Then you're supposed to multiply by returns of Y. For Y, you are not given the returns. What you are given is the expected returns. So therefore, you cannot use this formula. Sawa? Yes, you activate the other formula. What was the other formula? You take the correlation between X and standard deviation of X, standard deviation of? Good. Do you have the correlation between X and Y? Yes, the correlation between X and Y is 0.6. Standard deviation of X we have is 3.35, and standard deviation of Y is 5. Good. That's how we get the covariance between the two. 10.05. Good. Number 2. Advise the management of Rwanda Limited on whether to accept the proposed project using CML, capital market trend, whether to accept. Accept only if what? The expected returns of the security or the returns of the portfolio. Do you have the expected return? We are making a decision on whether to accept that project, right? And this is the expected return. The expected return is how much? So what you need to calculate is RS. How do you get RS? Risk-free, expected return of the market minus, you multiply by, very wrong. I read the question again to understand. Using the capital market trend. The capital market trend is applicable under portfolio theory. That's why I've said that instead of return security, it's return of the portfolio. CML equation, not SML. SML is the one that is used to evaluate the return of the security, evaluating the return of the portfolio. So using capital market trend, this under portfolio theory, to get the returns of the portfolio is the risk-free expected return of the market minus risk-free standard deviation of the, you multiply by the standard deviation of the portfolio, capital market trend. So in note number 4, you are given the risk-free rate. The risk-free rate of return is 8. Expected return of the market is what we have calculated here. We have all the ingredients required. A risk-free rate is 8. Do you have standard deviation of the market? That's what we have calculated here, 4.58. Then you multiply by the standard deviation of the portfolio. We are making a decision on whether to accept that project, of which the project we are going to take, the standard deviation was an amount of 3.35. 3.35. That's the portfolio evaluating, or the project we are evaluating. Are you getting? 11.66. So we are saying that you should only accept when the expected return is greater than the returns of the portfolio. Expected returns of the new project to be undertaken is 10.5. Its return is how much? So is it super efficient or inefficient? So this is inefficient. Therefore, you do what? Yeah, that was the question. Advise the management on whether to accept the proposed project using CAPM. Using CAPM, reject. Number 3. Number 3. Determine whether the project is acceptable. Now using what? Now using CAPM. Now using CAPM, also under CAPM, accept if the expected return is now greater than the return of the. Now this one I use the security market trend. Here using the capital market trend. So we already have the expected return is 10.5. So what we need is RS. Now using CAPM, how do we get RS? Risk-free rate, expected return of the market minus, you multiply by what? We already have the risk-free rate. Risk-free rate is 8. Expected return of the market is, risk-free rate is, beta, you don't have. But you have 3 formulas to calculate beta. How do we get beta of security X? We already have the correlations, right? You take the correlation between X and not X and Y. This specific project and the market, are you together? Yes, between X and M. Then you multiply by the standard deviation of the standard deviation of the market. Do you have the ingredient? Yes. The correlation between that project and the market is 0.24. Its standard deviation of X, that project, is 3.35. Standard deviation of the market is 4.58. And that's how you get its beta. 0.18. Eh? Yeah, so this is 0.18. Now give me RS. You're getting? 8.9, eh? So now we make our comment. You should accept if the expected returns is greater than the return of security. Expected return does not change. It was 10.5. And the CAPM is 0. Not 0, but 8.9. Now this one is super efficient. Therefore, this one you do what? Accept. Then, as an examiner, I ask you another question. So, can you see there's a conflict? Using CAPM, you are rejecting. I mean, using a CML. But using CAPM, you are? So, what could be the reason? I'm giving you 2 marks. The first one, So that means you have many. Good. Standard deviation, this one is it? Correct. In short, I'm asking the difference between portfolio theory and CAPM. Here using standard deviation. Here using the B. Now that one will give you another reason. For standard deviation, we are focused on the total risk. Beta, we are focused on systematic. Yeah, the risk that affect all the companies in the industry. So you can take a screenshot. Now let's proceed. Let's do another one. April 2024. April 2024. Question 2A. Two assets, A and B, are known on the security market, right? So if they are on the security market trend, that means it's at equilibrium. So if they are on the security market trend, what does it mean? It means that the expected return at that level is equivalent to the return of the security. That's when they are considered to be efficient. So if they are on a security market trend, it means that those security, they are efficient. And for it to be efficient, that's when the expected return is equals to the return of the security. Then I told that asset A has a beta of 0.5 and a risk premium of, now risk premium for the security is the same, because how do we get the risk premium? Yeah, the risk premium is the difference between the expected return of the market and the risk-free, of which the expected return of the market is always constant, risk-free rate is always constant. So that means for all the security, the risk premium will always be the same, and you are given is how much? So in short, the difference between the risk-free rate and the expected return of the market is 4%. That's the difference between the two. Asset B has an expected return of 20 with a beta of 1.75. So for B, we have everything we need. You are considering the foreign securities which are available in the market. You have security A, B, C, D, E. We have the expected return, that is ER, and then we have the betas. Required. Determine the risk-free rate of return. If you're not able to get the risk-free, forget about the rest of the questions, because risk-free is the backbone. How do you get the risk-free? So to get the risk-free is very simple. Can you go back to the first paragraph? Two assets A and B are known on the security market trend. Asset A has a beta of 0.5 with a risk premium of how much? 4. Asset B has a risk risk premium of how much? Mimi nauliza swali, correct? 4%. Tumeambiwa asset A has a beta of 0.5 and a risk premium of, now that's why I'm asking, asset B has a risk premium of how much? Yeah, we see that the risk premium cuts across. It's always the same because the expected return of the market does not change, risk-free does not change. So now you're to that. Asset B has an expected rate of return of 20. Expected rate of return. So how do we get RS? Remember, this is security market trend. So therefore, using SMA equation. How do we get RS? Risk-free plus minus risk-free multiplied by the. Now we are told that B, asset B has an expected return of how much? And this expected return, we are saying that at security market and they are efficient. That is the expected return of the security will be the same as the expected return. And they are told they have a return of how much? 20. We don't have the risk-free. How much is the risk premium? 4. There's a bit of how much? Has a bit of 1.7. Now the question is, I'm able to determine how much the risk-free rate is. So this will be 20. Risk-free, now 4 times 1.75? 7. Therefore, the risk-free, is it 13? Get 13%. Number 2 of the question. Calculate the required rate of return, which security. That is RS is the risk-free expected return of the market minus risk-free, you multiply by the beta, of which we have security A, B, C, D, and E. Risk-free is 13. That's why I was saying that if you're not able to determine the risk-free, forget the other part of the question. Expected return of the market minus risk-free, we get the risk premium. Do you have a risk premium? Yeah, the risk premium is 4. That one does not change. But they are subject to different risks. That is the beta. And this is 2, 0.75, 1.25, negative 0.25, 3.25. 8, 21, 3, 16, 4, 5, 6, 19. 18, 1. You get 12? Is it 12? Afanya mwisho. This one you get an amount of? Question number 3. Identify which securities are undervalued, overvalued, or corrected. Which one are efficient, super efficient, or efficient? How do you make that decision? By comparing what and what? Expect, hakuna standard deviation now. The expected return and the return of the security. So we have our assets, A, B, C, D, E. You compare the expected returns against the returns of the security. And you're given the expected returns, you don't have to calculate. So for A, it's 20. This is 14, 15, 12, and then we have the return of the security. This is 21, 16, 18, 12, and 20. Then you comment. If the expected return is greater than the return of the security, is said to be super. 2021, 2021, inefficient. Therefore means what? The security is? It's overvalued. 14, 16, inefficient, therefore has been overvalued. 15, 18, inefficient, therefore has also been overvalued. 12, 12, efficient, therefore has been, yeah, this one is correctly valued. That 126, this one is super efficient, and this one has been undervalued. Simple. Take a screenshot. August 2022. August 2022. August 2022. Question 5C. Now let's start with question 4. Start with question 4. A. Assess for circumstances under which a company would consider reorganizing its operation rather than liquidating. Company reorganization. Do you remember the reasons for reorganization? That's what they're asking here. Why should you reorganize? Mbona ujiteka mkutano instead of giving up? Are you getting? Mbona ujikaze kuliko to give up? Now that's what they're asking. Why should a company consider restructuring? Restructuring, that means that in this case, you want your company to remain as a going concern rather than liquidate. I can see you did it right. I'm not giving you any point. I've read for you the question. I've tried to interpret for you so that you understand what the examiner is asking. Something even you're not supposed to run in class. It's just to think. Now in this case, now you think like a business person. Why should you restructure my business instead of selling it? And you get how many marks? 4. It's based on how you think. Let's go to part B. In relation to corporate restructuring and reorganization, discuss the potential advantages of the company undertaking a divestment in one of the division by means of sell-off. What is sell-off? Selling for cash, right? Why should you sell something for cash? So what you'll do if you get cash? See, I'm trying to make you understand what the examiner wants. Are you together? The advantage of selling it. The other one is to do what? Demerger. Demerger is the opposite of what? Demerger is to come together, to separate, specialization. Weka huko. Instead of me combining 6 units, let me do 3, then 3. What are the advantages? You can be able to concentrate on divestment. What is divestment? Withdraw. So withdraw, even number 1, sell, it's part of divestment. Withdraw of an investment. Why should you withdraw your investment from a given company? To avoid what? Good. So what you are thinking, that's the answer. You see, now, can you look at part A has how many marks? A is 4 marks, right? Then part B has an additional? Those are how many marks? 10. Let's go to question 3A. 3A. Evaluate 4 benefits of currency. I'm sure you don't know. Let's go to question 5. 5 part A. 5 part A. Summarize 4 objectives of who? IMF. I'll be singing. IMF, World Bank. IMF, World Bank. You have all the information in your handout. You get how many marks? 4. B. Discuss 4 advantages of foreign direct investment. Also, that one was tested in December 2025. Advantages of FDI, foreign direct investment. Okay, the area has how many marks? Also, that's an additional 5 is 12 marks. Plus the other 10, those are 22. Plus 4, those are? Also, question 1, part C, it was theory. Factor that significantly impact on the price of cryptocurrency. That's what we call the emerging issues. I don't expect the teacher to teach you what is cryptocurrency. What makes the price of cryptocurrency to change? For example, currently they are changing, they are keeping changing. Because one of the leaders of the world is very uncertain. He always say that tunaenda chini. Are you getting what I mean? Tunaenda, you see, anamwonyesha tunapanda juu lakini anasema tunaenda chini. Going up? Are you getting? Going up? So that uncertainty, that's what makes them to change. And if you are a very polite person, do you know as a result of this war, there are people who are just millionaire, but after the war they'll be billionaire. Just need to understand how geopolitical works. Even in Kenya, here where we are, it's benefiting most of the people. Because number one, we are facing a problem, right? If you want to be rich, not just rich, wealthy, first of all, identify the problem. Currently, we're facing a very big problem. Once you identify the problem, now hire the best people. Then you try to reason out. You come up with a solution. If you want to be rich and wealthy, don't copy what others are doing. First of all, identify the problem. That's why the companies that come in Africa, you have a lot of problems. They always come here, not to see opportunity, no, to identify the problem. Once they identify the problem, they go back. They think. The problem there, how can I solve it? They come up with a solution. Now, once you give the people the solution, that's all. You get the reward. By the time others are copying you, you're already a millionaire or a billionaire. So don't copy what others are doing. First of all, identify the problem. Once you identify the problem, come up with a solution. Now give them the solution. So if you want to believe, that's why most of the people, they are the one who create the problem. I'll create a problem, I run away, then I come back. I give you the solution. But for me to give you the solution, you have to pay me. So in the process, I end up making some good money. But I told you that take CP as a business course. So not just a paper, not just a professional paper. Take it as a business course. So now let's answer our question. Question 5C. The following information relate to the performance of 3 portfolios, A, B, and C, during the year ended 30th of June 2022. So we have portfolio A, B, and C. We have the average return. Average means what? Expected. Can you write ER? ER. Then we have standard deviation. Then we have the covariance of portfolio returns with the market returns. Additional information. The market returns are the risk-free average to 14% and 7% respectively during the year ended 30th of June 2022. The standard deviation of the market is 10%. Required. Evaluate the performance of the 3 portfolios using Sharpes. Sharps. So how many portfolios do we have? 3. So you have the portfolio A, B, C. So how do you get the Sharps of the portfolio? Expected returns of the portfolio minus risk. Now the denominator is what matters now. Standard deviation of the portfolio. Good. Do we have the expected returns? The expected return is the average return. So we have 17.55. The other one is 13.26, and we have 9.34. And then you minus the risk-free rate. Additional information. Number 1, how much is the risk-free rate? It's 7. Then you divide by the standard deviation of the respective portfolio. Do you have the standard deviation? Yes. So the standard deviation we have 30, we have 34, and we have 28. Now give me that. You get 0.35. 0.18. 0.08. Good. And then number 2, trainers. So for the trainers, we have the portfolio. Then trainers for the portfolio is the expected returns of the portfolio minus risk-free. But now trainers deals with what? Beta. So in short, this one is concerned with the total risk. This one is concerned with the systematic risk. So we have the expected return of the portfolio, 17.55 minus 7. This is 13.26 minus 7, 9.34 minus 7. You divide by the betas. Do you have the betas? No, you don't have. But to get the beta of the security, go back to the information provided. Can you see the covariance? So now I gave you 3 formulas of getting beta. So the first one is using correlation. Are you given correlation? No, but we have what? Covariance. If you have the covariance, how do you get the beta? Covariance between the security and the market over the standard deviation of the market squared. That's how we get that. Of which we have the covariance. The covariance we have is 0 point. And the other one is? And the other one is 0 point. You divide by the standard deviation of the market square. This is the standard deviation. Additional information. The standard deviation of the market was how much? Standard deviation of the market is 10, right? So divide by 10 squared, right? 0.1. Now, in this case, you need to be very keen. Can you look at the covariance? Are your covariance in percentage? No. But the standard deviation are given in percent. So we have to convert. The other one you divide by 0.1 square, 0.1 square. 0.88. 7.5. 0.21. Good. So we needed the beta. This is 0.88, 7.5, 0.21. This one is 11.99. See? 11.14. This one is 0.8. Very good. So you can take a screenshot. But so I'll say that if you want to be successful, do first of all identify what? The problem. Then you look for a solution. And there are a lot of opportunities. There is a lot of opportunities. Shouldn't DCI? No, but in this case, my advice, if you want to live well, you know, you always say that money is money, whether legal or illegal. But with clean money, you'll always sleep peacefully. With clean money, you always, and they are there. I'm not supposed to tell you, but in the next 10 years, make sure you have my number. I'll be a billionaire, not millionaire. Yes. But let me tell you one thing, Nimpatie siri, no. I should not give you, because I'm very good when it comes to geopolitics and research. Now, for example, the generation we're having now, so most of you are millennial. Then we have Gen Z, right? What's the other generation? Alpha. That's my next project. Sitamwambia venye nafanya. So you have to run venye watakuwa. Understand that generation. I'm trying to give you a research. Na hiyo hautafikiria ukiwa hapa shule, hapana. That's when after you do the exam, ukiniona nimerelax mahali, nimerelax mahali, because for you to make this decision, number one, you need a clear mind. When your mind are fresh, that's a big project. You see, for you to become a success, it's not about a strategy of 1 year or 2 years or 3 years. You plan long term. 5 years, 10 years. Nimesema miaka ngapi? Miaka 10. That's the generation we are dealing with now. So, for example, in the next 10 years, so the early Gen Zs, the last generation kuoa, the rest hawataoa. Do you know that? You see, you think I'm saying this as jokes, Conduct your research. Currently, men's, even ladies, Gen Z, you cannot marry Gen Z. Nimesema the last one ni early Gen Zs. Hawa kutoka 98 mpaka hapo 2003. At least that one unaweza oa. From there, let me tell you one thing. Kama mwezi mwambia msichana wa mtu kitu, do you think utamweka kwa nyumba mwambia akupikie? No, that's the reality. So, in the next 20 years, hakuna marriage. Takwambia mimi nataka mtoto nikae maisha yangu, weka kivyako. Na saizi imeanza kufika saizi. Nowadays, nowadays kuoa is not a priority. Ama ni aje? Kuoa is not a priority. Hata mimi niko hapo, that's not a priority to me. That's not a priority to me. So now you can imagine about the generation to come. I'm trying to give you a hint. That is 0.01% of what will be happening. Sawa? Yeah. So you read their mind. So by the time wanakuwa mature, hata si mature, because nowadays you see, mtoto by the age of 14 wanajua Kenya wanataka. So it's upon their parents kuambia, nataka hii, make sure you have it. Make sure you have it. Then online kwa huko. Then unatumia the predictor. Nowadays AI iko na predictor mingi sana. Iko na a lot of information. That's why they're investing a lot for artificial intelligence. Data collection center. They can be able to do an analysis for you. Wanataka nini, watakuwa wanataka nini. Utilize. Also, investment means that ni lazima uwekele pesa. Whenever there is a seminar, this seminar they cost even 70,000 for 2 days only. Ukisikia 70,000, wanasema afadhali wewe ununue lita za 100, uangalie masocialite, but with someone anajua mahali anaenda, hakuna kitu more valuable than information. Than what? Information. And people pay a lot for information. Unaniuliza information, nakwambia just give me 2 minutes. I know a guy who knows another guy. That's how information works. For them to know the information, make sure now wako kwa your payroll. Ama ni aje? Information is everything. Pata information, pata connection. How this year akikuja know who to call. That was a Bible. It's a food for thought. So. Now let's do another one. So we have done for August 2022. Let me see this one. So that one you had already done. April 2023. April 2023. April 2023. Question 3C. April 2023. Question 3C. Now, this letter that you have been appointed as a finance manager of Mamba Limited. After evaluating the investment portfolio of the company, you have divided the market into 4 portfolios following 2 dimensions. That is value, growth, and small or large. That's the size. So the weight of each portfolio in the index is as given below. So we have portfolio, we have small value, small growth, large value, large growth. Then we have the risk premium. We have the weights. Then we have sensitivity to factor 1. You see that sensitivity means what? Oh, sensitivity means what? Beta factor. Sensitivity. Can you open your notes? Open your notes. Open your notes. Go where you wrote CAPEM. Go where you wrote CAPEM. Are you there? Where you wrote CAPEM. Now go where we have measuring systematic risk. Measuring systematic risk. Are you there? Now I want you to read what you wrote. Systematic risk is measured using what? Beta. Now I need the next statement. Watch here hapo. Beta factor is a measure of sensitive. How sensitive? Now let's go. If you don't interpret the question correctly, you are out. So for example, in this case, if you're not able to know that sensitivity means beta, you unaondokea vizuri. So you have weight, sensitivity to factor 1. Can you write that one as a beta? Write it as beta 1. Then we have sensitivity to factor 2. That is B2. Sensitivity to factor 3. It means that we have 3 factors. Then we have the risk-free rate is 3% required. Using the arbitrage pricing theory, determine the portfolio that has the highest expected return. Arbitrage pricing theory. You see that arbitrage pricing theory, it's a multi-factor model. It assumes that there are several factors which affect the return of the security. How many factors do we have? 3. So therefore, to get the returns of the security, you take risk-free expected return of factor 1 minus risk-free beta of factor 1, expected return of factor 2 minus risk-free beta of factor 2, expected return of factor 3 minus risk-free beta of factor 3, where the difference between the expected return and the risk-free, the expected return of the market and the risk-free is known as what? It's known as what? Risk premium. And you are given. So what we'll do, we have the portfolios. We have small value, small growth, large value, large growth. Do you have the risk-free rate? How much is the risk-free rate? We have is 3 plus. If you take the expected return of factor 1 minus risk-free, you get the risk premium of factor 1. Do you have the risk premium? Yes. The risk premium is how much? It's 8. Now, factor 1 was the market beta. And the market beta, the last item given is the risk premium. So you already have this, the difference. Then you multiply by the beta, and you see that sensitivity means the beta. For small value was an amount of 0.87, 0.97, 92, and 1.12 plus the expected return of factor 2 minus risk-free. The difference between the two, you get the risk premium of factor 2. These are different factors of factor 2. Do you have the risk premium? Yeah, factor 2 was the price of the book, which was an amount of -3. Then you multiply by its beta. Beta of factor 2, this one is 0.8333, and we have negative. No, this one is 6. Plus expected return of factor 3 minus risk-free. The difference between the two, you get the risk premium of factor 3. Do you have the risk premium? Of which you are given is 0.4. Then you multiply by its beta. Do we have the beta? Yes. Sensitivity to factor 3, which is average capitalization, we have 2 to 2022. Give me that. The first one is 8.87. 27. 8.27. And the second one is 10.7. 57. The last one is 3.4. The last one is 2.76. This one you're getting? 3.36. And number 2, just a minute. So now the question was, using the arbitrage pricing theory, determine the portfolio that has the highest expected return. Which one has the highest? Small growth, right? Good. Number two. The portfolio that would maximize your return, if you decide to use what? CAPM. CAPM is a single factor model. Using CAPM, the return of the security is the risk-free. Expected return of what? The constant will always be market. For APT, there are other factors apart from the market. Minus the risk-free, you multiply by the beta. So small value, small growth, large value, large growth. Risk-free rate does not change. Now, among us three factors, can you see the market? Can you see the market?
Yes.
That was which factor? Factor one, correct. So factor one is the one that represents the market. So therefore, the difference between the expected return of the market and risk-free, you get the risk premium, which is an amount of 8. Good. And then you multiply by its beta. The beta of 0.879792 1.12. Yes. 9.96. Yes. 10.77. 76. Last one. 96. 10 point. Now using CAPEM, which one has the highest return? G, good. And then number three. In order to diversify his perceived risks, a competitor wants to combine the small value and large growth. Small value and large growth. Let it be X and Y. If you combine the two, you form a portfolio. In order to diversify his perceived risk, a competitor wants to combine small value and large growth portfolios. The new portfolio should have an overall sensitivity to factor 1. That is equal to market beta of how much? So it means that if you combine the two, the weighted beta of the portfolio, if you combine the two, should be equal to how much? Equivalent to that of market. If you combine the two, the beta should always be equal to 1. That means when the market changes by 1, the portfolio returns also changes by 1. Now, what is the question? Determine the proportions, weights. Determine the proportion to be invested in the small value and we need the weights. So how do we get the weights? We know very well, when you take weight of X plus weight of Y, they are only 2. The weight should be equal to 1. Good. What does it mean? So it means that now, in this case, we are taking the average. So if you take weight of X, beta of X should be equal to weight of Y, beta of Y. Kwa pamoja? Weight of X plus weight of Y is equals to? Can it be able to make weight of X the subject? So to get the weight of X, let me write it here. Weight of X, take this to the other side, be equal to 1 minus weight of Y. Good. Do you have weight of X? Weight of X is 1 minus weight of? Do you have the beta of X? Okay, X represents what? X represents small value. Sawa sawa? Hata iko hapa. Small value has a beta of how much? 0.87. Weight of Y, beta of Y. Y represent what? Large growth. Large growth has a beta of how much? 1.12 weight of Y. I've just substituted. We open the bracket, this will be 0.87. 0.87 weight of Y is equals to 1.12 weight of? Take this to the other side. So 0.87, if you take this to the other side, it becomes plus. 1.99 weight of Y. Can we go to get the weight of Y? Divide both sides by 1.99. 1.99 weight of Y. 0. Automatically weight of X. Weight of X, you take 1 minus weight of Y. 0.5. So that means small value, this is weight of X. Small value is our X. Here you invest 0.56, which will be an amount of, an equivalent of 56%. Large growth is our Y. Y is 0.44, which is equivalent to 44%. So you can take a screenshot. Any question? We do another one. May 2016, question 2A. May 2016, question 2A. Question 2A, you are told that a Biashara Limited wishes to invest in stock M and N in two different industries. The following information related to the two stocks. We have stock M and N. So we have the expected return, we have the standard deviation, we have the beta coefficient, amount of money invested. Now the amount of money will give us what? Will give us the weight, correct? So M, N. How much are you investing in M? 1.2. In N you're investing? So the total investment is 2. So you divide by 2 million. Divide by 2 million. That is 60%, right? Therefore, this is, you get the weights. Required, the expected portfolio return. If you combine the two security, you form a portfolio. And how do we get expected returns of the portfolio? Weight of M, expected returns of M. Weight of N, expected returns of, we already have the weights. 0.6. How much is the expected return of M? It's 18%. Weight of N is 40%. And the expected return is an amount of? So if you combine the two, you get the average for the portfolio. Right? 17.2%. Number 2. Explain the effect of the portfolio risk. Portfolio what? So the keyword there is risk. Explain the effect of the portfolio risk if the returns of security stock M and N were perfectly positively correlated, including suitable what? We read that again. Explain the effect of portfolio risk if the returns of stock M and N were perfectly positively correlated. That means correlation between M and N will be positive. So the effect of risk. So in this case, if you combine the two, form a portfolio, right? Now the question is, that's what we call the percentage of risk diversification. If the two securities are perfectly positively correlated, the percentage of diversification will be 0. There is no diversification here. So, okay, what does it mean when it's perfectly positively correlated? It means that if M increases by 10, N returns also increases by 10. If one increases by 100, the other one increases by 100. If one fails or falls, what happens to the other one? That means there is no diversification. Now, diversification is where, hapa ikiumana, at least you have a plan B. Are you together? But now, all the plans you have, they are the same. So, ikianguka moja zinaanguka zo. So, that means there is no percentage of risk diversification. And that's how we prove. So, we can prove using the percentage of risk diversification, which will be 0. Have you understood what I have said? So I have said that if M and N are perfectly positively correlated, it means that the two security returns are moving toward the same direction at the same pace. Same direction at the same pace. So therefore, there is no diversification. How do we get the percentage of risk diversification? So that you take the weighted standard deviation of the portfolio minus actual standard deviation of the portfolio over a weighted standard deviation of the portfolio times 100. That's you're looking at the effect of risk. Risk of the portfolio is measured using standard deviation. So now let's start with the weighted standard deviation of the portfolio. You take weight of M, standard deviation of M, weight of N, standard deviation of M. Weight of M, these are the weight. So 0.8. And how much is the standard deviation of M? 0. Oh, this is 0.6. The standard deviation is 8 plus weight of N, which is 0.4. Standard deviation of N is, so now give me the weighted average. 7.2. Then you compare, we also need actual portfolio risk. So how do we get the actual standard deviation of the portfolio? Weight of M squared, standard deviation of M, plus weight of N squared, standard deviation of N, 2, weight of M, weight of N, covariance between X and M and is it that in this case, are you given covariance? If you are not given the covariance, how can you get it? You take the correlation between M and N, standard deviation of M, standard deviation of all of it to get what? Square root. Weight of M is 0.6 squared. Standard deviation of M is 8 squared. Weight of N is 0.4 squared. Standard deviation of N, which is 6 squared. 2. Weight of M is 0.6. N is 0.4. We don't have covariance, but we have the correlation. How much is the correlation? It's positive 1. Standard deviation of M is 8. N is 6. 8 and 6. Then all of it, you get the square root. And this one, without calculation, you can calculate. I did confirm, using a calculator is a concept. Have you confirmed? You're getting? So now we can get the percentage of risk diversification. Weighted was 7.2. Actual was 7.2 over weighted of 7.2 times. And did you get? Passing. There is no diversification. Parts B of the question. No, part B is not necessarily we do it because the first question we had done, it was similar to that. Mapen Limited Investment Fund comprised of 4 major projects. The details of the project are as follows. We have project 1, 2, 3, 4. Market value of the fund in percentage. What are those? Those are the weights. Then we have expected return, standard deviation, and we have coefficient of correlation with the market. The risk-free rate is 5%, and the market returns is 14. The standard deviation of the market is 13. So required. The beta coefficient of the investment, the beta coefficient, investment fund, when you combine all of them, that's what we call the weighted beta. Weighted beta of the portfolio. So we'll be taking weight of project 1, beta of project 1, weight of project 2, beta of 2, weight 3, beta 3, weight 4, beta 4. Do we have the weights? Yes. So we have the market value of the fund. So you already have weight. So the formula is the most important. So you have the weight. Do you have the betas? It is not there, right? But do you have the ingredient required to get the beta? Yes, to get the beta of the security. What do you have? You have correlation. So you take the correlation between the security and the market, standard deviation of the security over standard deviation of the market. So for 1, 2, 3, 4, I'm just giving you a hint on how you're supposed to calculate. Correlation between 1 and market is how much? Yeah, 5, 5. The other one is 0.75. The other one is 840. Then you multiply by their standard deviation of the respective securities. And standard deviation for one is 15. We have 20, 14, and all of it you divide by the standard deviation of the market that were given before required. The risk-free rate is 5. Market return is 14. Standard deviation of the market is 30. Don't calculate. I'm just trying to give you a hint. So once you get the beta for each, then you substitute here. Weight of 1, beta of 1, so that you get the combined. Number 2, by comparing the expected return and the required return, that's enough. Advise whether Mapen Limited should change the composition of the portfolio by comparing the expected return and the return. So you compare expected returns. Do you have the expected returns? Confirm. Do you have expected return? Yes. You compare against the return of the. How do you get this one? Is risk-free plus expected return of the market minus risk-free multiplied by the. Yes. Do you have the risk-free rate? Expected return of the market? Risk-free? Now the beta is what you have calculated here for each project. And then you comment whether they are super efficient or inefficient. Then changing the composition to a device. If it's super efficient, you do what? Just comment there. Super efficient, you buy. So you comment by buy more of this, sell this. Take a screenshot. Time is up, but the question I just want to mention. You can do the last one. but I'm not doing it free. November 2017. November 2017, question 2C. November 2017, question 2C. No, it should be November 2017, not 2016. Now let's start with A. A. Discuss 3 reasons why economic value added, have you ever heard of EVA? Good. Is gaining prominence as an alternative measure of companies' financial performance. Reasons why EVA is gaining prominence. It's more of the advantages of EVA. See that EVA uses cash flows, and therefore it's not easy to manipulate. It considers the cost of capital. It indicates the true value of wealth created by the company. It's also consistent with the shareholders' goal of wealth maximization. Easier to explain to shareholders and to managers, etc., etc. Part B. With reference to financial management in the global context, distinguish between the following terms: a Eurobond and a Euronote. Have you ever seen them? Yes, at least there is a one, yes. Number 2, an option being in the money and out of the money. I'm sure that one you have never heard of it. Have you ever heard of it? Now, those are 10 marks theory. 10 marks theory. Part A and Part B. C. Wekeza Investment has initiated an investment fund called FIDICA, the fund of which will be invested only in stock and bonds of infrastructure and construction companies. 60% of the funds will be invested in companies engaged in the commercial construction services, and the other 40% in companies engaged in developing residential properties. Those are the two portfolios. The average beta of returns from development of residential property is 1.9, and that of commercial construction services, how much? So we can be able to get the weighted beta. So we take weight of A, beta of A, weight of B, beta of B. The weight of A, second paragraph, investing how much? 60%. How much is beta? 1.4. The other one is 40%, 0.4, with a beta of 1. No. The teacher is always correct. Can you read that paragraph slowly? Okay. Tell me who is confused. Okay. See what the examiner had done. So for the weights, he started with weight of A, weight of, but for the beta, they have started with beta of B and beta of. So mine is correct. So now give me the weighted if we combine the two. 1.6. 1. So the average investment will be having 1.6. Then we are told that the benchmark returns is 11.2. Benchmark market return is 1.2. And the Treasury Board carries an interest of 4.25. Return of the security, risk-free, expected return of the market minus risk-free multiplied by the beta. Do you have the risk-free rate? Yes, we are told it's 4.25. Do you have expected return of the market? 11 point? A risk-free rate, we are told, is 4.25 with a beta of 1.6. %. Then we are told that the following information on the net asset value per share is provided. So you have the month from January to December. What you're given is the closing net asset value. Then we have the dividend paid. Then I told that the opening net asset value in January was 17.75. This is the question that was tested in December 2025. The first question we did there. Required. Calculate Jensen's alpha relating to Faidika and use it to evaluate the fund performance. Jensen's alpha. Do you remember that? Jensen's alpha. How do we get alpha? Is the difference between expected returns minus the return of the, we already have the return of the security. We get the expected return. You see that whenever you're not given the expected return, to get the expected returns, you take P1 minus, so that we get the capital gain. And in case they are being paid dividend, you add what? Over the initial investment. So that's what you'll do. This is what you'll do. January, February, March, April, May. Let me just do to May. You take P1, you minus PO, you add D1 to get total returns. Now, for example, so P1 is the closing net asset value. PO was initial. So what you are given is the closing. So January, at the end of January, iko ngapi? February, March, April, and May was 17 point. That's enough for me. And then let's go to the last point. The last point. The opening net asset value for January was 17 point. January at the beginning was 17 point. At the end is how much? 18.6. So the closing balance here January, do itafungua fe? So how much is the opening value? The closing will be 17.8. The closing for February becomes the opening for? Good. This one will be 17.8. This will be 18 point. This will be 17 point. 18. Good. 18. At upper, we can be able to get the capital gain. So to get the capital gain, you take P1 minus PO. We started with 17.75, and then it's 18.6. So you take 18.6 minus 17.75. 0.85. 17.8, 18 minus 0.6. That's our capital loss. Loss of 0.8. 18.2, 0. 18, 18.2, which is a loss, right? 17.8 and 18, 0.2, gain or loss? Loss. Those are the capital losses. Then we add dividend in case there is any dividend. And if you look, the dividend was only paid for 2 months, right? Only in February and June. For example, February, they were paid a dividend of 0.75. And that's how we get our total returns. So you can call it A, you can call it B. A plus B. So this one meant to be 0.85, 0. Here they earn some dividend. So you get negative 0.05. Is it so? Yes. This one is 0.4, 0.2, 0. Then from there you multiply. Can you get the expected return? You see that to get the expected return. So what we have had here, DOE. So let's call it what? C. The total return. So to get the expected return, you take your C. Now C is the capital gain plus any dividend. You divide by the initial price. So initial price PO over PO times 100. Kama utachukua 0.85 But at the beginning, the investment was 17.75, you get? 0 point? 4%. Then you do all of them up to December, you add. So what you get, for example, let's assume you get 15.9, I'm just assuming. Then from there, you get Jensen's alpha. By taking the expected return, what you'll get there, 15.9 minus RS, which you have is 15 point. Can take a screenshot. So I'm not wrapping that. Just to mention, I want to make sure that I've equipped you December 2022, question 2B. I'm not doing, I'm just mentioning. So I don't want to come back to this. December 2022, question 2B. I'll start with question 2A. It's on the same topic. Let's start with question 1. A. Explain the term real options as used in capital investment appraisal. Do you remember that? Real option. That one we discussed when we were discussing which topic? So the second last topic. Bracket and score. How to get ND1, ND2. When we were done, we discussed real option. Real option. And even we discussed 3 types of real option. An option to expand, to delay, to withdraw, or to abandon, right? And I've actually answered part 1 and part 2. So explain the term real option as used in capital investment appraisal, 2 marks. Evaluate 3 types of real option. Now, in addition to that, also buy or lease is a type of real option. Replacement option, whether to replace an asset or not, it's part of that. And so you can just explain it and you get your 8 marks. Let's go to question 2A. The modern portfolio theory is a practical method for selecting investment in order to maximize their overall returns within an acceptable level of risk. Required. Evaluate 5 assumptions of modern portfolio theory. Ignore modern assumption of portfolio theory. Remember the assumptions? I gave you assumptions of portfolio and assumption of capital. Kindly don't confuse the two. Investors are risk averse. Okay, the question is, do you have them? Yes. Good. Another 5 marks. So there was 8 marks plus. Those are how many marks? 13. If I were you, but the problem, I'm not you. I'm not you. But passing an exam is also, it's all about also coming up with a strategy. So, strategy. Some of you have a strategy. Eh? Do you have a strategy? Eh? Part B. The following information is provided on the market, risk-free rate, and the two stock, A and B. So we have the expected return, correlation with the market, then we have the standard deviation. Now the first one, can you see the expected return? The first one is 4%, and that one belongs to the treasury bill rates. As a smart student, what is that? Risk-free. Good. Adika hapo RF, risk-free. Yeah, government security, they are considered to be risk-free. So that's the risk-free rate. Then we have S&P 500 index. How much is the return? 11. What is that? You know, that's the reason I've said that we look at this question. I'm not doing it. I'm just giving you a hint. So, that's the market. What determines the average market? Okay, what do we mean by S&P 500 index? 500 index. Umwende muguku after that. So, yes. What determines the performance when they say that our economy is growing by this? So from NSC, they look at the average performance of the top 500 companies. That's what determines the average for the market. S&P 500 index, that's the average market. Can you write it as ERM? ERM. Good. Then from there, you have for stock A and stock. So the rest you can be able to answer. So that's enough for you. So now I think you can be able to answer.